Hey guys, this is Brent Neely with Neely Property Investments. I'm reviewing 15 to 20 deals per week, looking for opportunities to be able to buy and offer to my investors. I turned down almost all of them, and I thought it would be interesting for me to share just kind of going through my thought process on a particular property and why I don't think it's a good opportunity for Neely Property Investments. So I just looked at this 18-plex, I guess, this apartment building in American Fork, Utah, which I don't know anything about that market other than I looked at some statistics and it looks like a fantastic and growing market. However, with this property, it's going to be a hard no for me, but I'll go through why and kind of help you understand. First of all, they're asking a 4.4% cap rate, which means I can tell you right off the bat that this is not going to cash flow. Immediate disqualifier. If you take 5.25, their asking price, 5.4 million, probably be able to get a loan for about 65% of that. So it's going to take almost $2 million to purchase it. On this size asset with long-term debt, you're probably about 5.7% interest that I could get right now. So the monthly multiplier for that's 0.059 on a 30-year amortization. I did that wrong. 5425 times 0.65 times 0.0059 times 12. So the annual payment on the debt service would be $250,000. The pro forma NOI right here, which is the net income, is $238,000. So you're backwards negative cash flow about $12,000 year one. And that's really because your debt interest rate is higher than your cap rate. So you have negative. It's not a deal that I'm going to do. It's also based on pro forma here, which means it's an estimate. Usually the broker or somebody puts it together with their best guess, but generally it's more favorable to the seller when they're advertising this, and it's in a perfect world that you can hit that. So there's going to be some more risk there. The other issue is that this is 100% occupied, Class A, brand new construction. It's going to be very little value that I could add to the property. There's not any way for me to make life better for tenants or make the property more desirable to live in. It's pretty much done. So you wanted a real low headache, no maintenance type of asset. This might work, but there's a few other reasons that I'll get into as we go through here that might not be a great idea either. So if we look at the OM, back up to the top, again, it's beautiful. However, it is one of, there's 216 units in this development. So let's see, 216, it's 12 buildings. So there's going to be 12 different property owners with the exact same asset, the exact same floor plans, the same buildings, and the same parking lot that you're going to be competing with for tenants. So, while you could probably have a common management company, talk about not being able to differentiate yourself. So yeah, I wouldn't go there for that. Let's go down and look at the rents. Where'd they go? So 14 to 1445 for one bed, around 1700 for a two bed, and just 2100 for a three bed. So I use Hello Data to look at a market here. So I don't have it filtered to just Class A. Let's change that real quick. So we'll say built within 2020. How long it'll take to load. The rents on newer properties are 1300, one bed, 16, and 21. So they're a little higher than the market on the one bed, a little higher on the two bed, and then right there with the three bed. But they're definitely not below market at all. So not going to be much lift there. Okay, so this is the pro forma income that they're coming to with that 238. Remember, we had about $250,000 in the debt service. As we look through this, they only have vacancy at 3%, which is it's possible in a tight market, but that's like I said, everything's going perfectly. Management fee. So HOA, I was a little concerned about that since there's 12 other buildings in the same common area. They've established an HOA to do all the, I don't know, I would assume all the exterior maintenance, potentially utilities, landscaping, snow removal, that sort of thing. It's a huge red flag to me. I mean, I don't know if you've ever lived in a single family home that had an HOA, but you lose a lot of control. One of the ways that we make a profit in investing in apartments is to be able to reduce expenses, to find better vendors that can do things for cheaper, or to restructure expenses in ways that you're giving up all that control right here. And then it looks like between HOA and property taxes, which you also have no control over, you're like 65% of your expenses. So you're not going to meaningfully be able to reduce expenses here. Also like to look at a lot of ratios. So if you just take this expenses divided by the income, so they're at 30.7% on their expense ratio, which again, same thing. While it's plausible, if I was underwriting this deal, on what I would say is more realistic, I would have a 35% expense ratio, which would add another $15,000 to the expenses. You know, maybe in some properties you could reduce that. However, I see this as a big risk with the HOA, especially since the developer is trying to sell these properties right now. I would imagine the HOA is being managed pretty strictly, but as the years go on, that can be a problem. Yeah, look at this. You're competing with 17 other investors. Not a great idea. Let's just look at the market real quick. The development pipeline. So this is actually really solid. There's 31 properties that are newer. This number isn't always super accurate on how many listings, but yeah, 1,437 units. So there's 700 in planning, but those are all on hold, I'm sure right now. Only 87 that have already broken ground. So this is a really good sign for the rent growth of the area, as Hello Data is showing population growing pretty significantly. So I'm sure that this is why, and then Hello Data puts all that together to forecast rent growth. It's been negative apparently, but now we're looking at 5, 7, 5, 2, 4%. I think once it gets out 5 years, it's not, well, probably once it gets out over more than 3 or 4 years, it's not very accurate. But so this is probably why the broker and seller think that they can ask a 4.4% cap rate, because people will underwrite this for 5 to 7 years and they'll bake in all this rent growth so that overall it starts looking good, but they're going to go negative cash flow for the first 2 or 3 years to get there. I don't buy that way. I want cash flow day one. Cash flow is what offsets a lot of the risk. I mean, if you have a property that you're having to pay and then, market turns or things get worse, it just gets worse. So this is a hard no for me for a lot of those reasons, but I would look forward to connecting with you. If you'd like to learn more, I have a full due diligence center that talks about my philosophy, and there's links to sign up for my newsletters and to book a call if you'd like to sit down and have a conversation. So I hope that you found that interesting, and we'll talk to you soon.